Turtle soup can form right before a macro or just after a macro begins. But knowing the narrative of how that daily candlestick is going to form a down close day or an up close day is going to be understood based on where the liquidity is and how we start the day. Is it going to rally first and create the high of the day, or is it going to sell off initially, trick people short, leaving relative equal highs that they run for later in the day? That creates the high of the day, and the only thing they're really running out is the engineered buy side liquidity. Then send it lower for the close, and that's your narrative. That's the bias is short, but it isn't always open, go straight down close. How we trade initially after the opening, because in a perfect world, what we want to see is when we're bearish, it opens, rallies up, and takes out the liquidity above 7 to 9 o'clock in the morning, or London high, or Asia's high. And we use the economic calendar to bridge that. Which one do I really want to focus on? But we always, every single day, use the liquidity that's formed just after 7 o'clock Eastern time, prior to the 9:30 opening bell. Those pools of liquidity cannot be hidden from you. And when it's a clear, obvious relative equal high or relative equal low, and it would match how the daily candlestick should form for the purposes of Power 3. In other words, you're bullish, your bias is bullish. You think the weekly chart's going to keep working towards a level higher. Okay, wonderful. That means you're going to be looking for easy bread and butter idea is at 7 o'clock in the morning, go to 9:30. At 9:30, in that last 90 minutes, where is the relative equal lows? If there is no relative equal lows, just find the lowest low, if it's a singular low. That's where you're going to expect the price to drop down in a perfect world. But because we have to watch and see what the opening range can do for the first 30 minutes, unless it just does exactly what we're expecting right out the gate, which is a Judas swing, and when we're bullish, it drops down and goes for the liquidity. Then you know what you're waiting for. Go down there and get it, soup it, use the first resistance fair value gap that you come to after it runs the liquidity. Okay, it's a little variant on the gauntlet. It doesn't have to have a breaker there. Okay, so running it, I have to slip that in there. And people that didn't stay on, they didn't hear that. But the raid after going down to hit that sell side, even if it's going to go lower, the chances of you getting 50% of that drop down, that many times can be a trade. It can yield you 20 handles. It could yield you, and in today's volatility, it could be as much as 50 to 100 fucking handles. It's relative to what you're seeing in terms of volatility at the time when you're looking at the market versus